Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hey everybody, welcome to another edition of Facts versus Feelings. Ryan and Sonu back, and we are coming to you from Las Vegas. And you might hear some music. We're at the Excel Conference. Carson's Excel Conference is an awesome time. And we have Gargi with us. I'm just going to call her Gargi because she's like Madonna, going by a first name basis. And Gargi, I saw you bobbing your head because this music, it is pretty loud, but hopefully we're going to do a good job to get rid of it. But it's not bad music, isn't it? Pretty good.
It's amazing, and thank you for having me. This is fun.
No, this is going to be a lot of fun. Again, so, Sonu and I like to have some fun. I mean, let's just start things off. We're in Vegas, right? What's kind of your favorite Vegas story or experience you've had? And, I guess keep it work-friendly, but still maybe a little fun back in the day.
I will say that Vegas is not my scene.
Okay.
I am more of an outdoors, nature, running, hiking sort of a human being. But in my 20s, I did spend a lot of time in Vegas, going out here in the clubs and enjoying the restaurants, but just not my scene.
Gotcha. So, Sonu, I'm going to go to you in a second with the same question. But, Gargi, you're the special guest of honor. You're at BlackRock. Tell the listeners in a couple, maybe 90 seconds or so, what you do and kind of how you help investors.
Sure. So I run our investment strategy as well as our markets group. And what that really means is helping investors think about the entire life cycle of an investment. So what is the macro regime, which I'm sure we'll talk about, and how have things changed from the last month, the last week even, in the markets, and how should you change your portfolio alongside that? I mean, we're all long-term investors. We all want to be invested for the long term, but there should be some changes you're making at the margins, and how to do that with iShares ETFs in particular. Yep. And then lastly, we tell investors how they should be thinking about what an investment like that should cost.
Awesome. Well, that sounds good. We're definitely going to have some macro talk here in a second. Sonu, do you have any fun Las Vegas stories?
I'm at, way back. So when I was in grad school, I was in Indiana. I was at Purdue for grad school. And every summer, college emptied out. And we used to be like, well, let's take a drive out west. And west meant Las Vegas. But we used to, to Gargi's point about enjoying the outdoors, we used to stop at the Grand Canyon on the way in and the way out. So we ended up spending more time at the Grand Canyon than Vegas itself. But, a little bit of blackjack here and there is always fun. And
exactly. I bet you're a good blackjack player.
I don't know about that, but I'm still trying to figure out craps. I have no idea how that works.
I can't figure it out either. Everybody just yells and then the money's gone. I don't know.
What about you?
Yeah, one time I was probably in my low 20s. I remember I was playing 3-card poker, hit a straight flush. It was like $1,000, and maybe I had a drink or two. I remember I jumped on the table and started dancing, and they got me down. I got kicked out of the casino. They knew it was all in good fun. But let's move forward. So Gargi, the big thing obviously this week, inflation. That CPI number came out just the other day. A little hotter than expected. I'll be honest, I didn't think it was that much hotter than expected. But then we had, you were just telling me some stats. I'd like you to do this again, how bad it was for markets. I mean, what's your take on the inflation data and the market's reaction, I guess? Let's start there.
Sure thing. So, to your point, the markets sort of going into that inflation data was expecting a weaker number. So that's why even though on a headline basis, it was not that much of a shock, perhaps it was a huge shock on two fronts. Number one, versus expectations versus the whisper number that was just the markets were pricing in something softer. But then the core inflation, and just for our listeners, core inflation is the inflation that subtracts the more volatile parts of inflation, which tend to be food and energy prices. That core number at 0.57% month over month was almost 3 times, or at least definitely twice more than what was expected. And more importantly, the details of that core were a little troublesome. So there was strength in areas of the economy where we thought we would see some softening, in the goods sector particularly. And of course, the services sector of the economy is doing very well, and it continues to be quite inflationary. So I think the details were what was very concerning to the markets.
No doubt. So we'll talk about what the Fed will do and what it means for the Fed in a second. My take is we saw lower prices in used cars, lower prices in airfares, but most of the other things, Sonu, were a little hotter than expected, right? Like dental services, healthcare services, tobacco. I mean, things I don't smoke, but things people really use. It's the realization it was a disappointment. I mean, what else was your take on kind of peeling back the onion, so to speak, when you looked at some of that data?
I mean, you just mentioned used cars, right? I know you and I track the Manheim Used Vehicle Index.
Right.
Look, that index is down about 11% year to date. CPI used car inflation is down prices are down about 2%. So there's clearly some disconnect that, what we seem to be seeing from some of these leading indicators, let's call it leading indicators that correlate with consumer price data. There's a big disconnect there, right?
Yeah.
And, I was going to ask Gargi this about apparel prices, going back to outside of services, right? By now, for every retailer saying, we are discounting apparel prices.
Yeah.
Right? Walmart's saying it, Target's saying it, but apparel was positive.
The new shirt I'm wearing right now, I got on sale last week.
Yeah,
so everything is.
So that's not, by now we would have expected some of those, let's say, like home furnishings, apparel, stuff like that, used cars even, causing a deflationary force to inflation, but we're not seeing that, right? Like
we aren't, Sonu. It's a great point. So, when we heard the earnings report from second quarter, there was this talk about an inventory buildup, and we did expect to see that flow through at least by now, into some of the goods inflation measures. Also, I know you guys, I'm sure, track every measure of supply chain indicators. I know I do, and we look at the freight prices and how much a 40 cubic foot container has dropped when you're thinking about Shanghai to LA. Those prices have dropped meaningfully, which obviously has a follow-through impact on goods inflation. I will say that part of this is timing. So it did not flow through, to your point, on used car as well. It did not flow through from the Manheim index into the used car of CPI. Does not mean that it won't happen. It will hopefully happen. But the reason that the market had such a reaction, and I won't even call it an oversized reaction. I think it was a very fair reaction given the rally that we'd seen since the beginning of September. And it was an unwind of some of that rally. I'll say that the reason that the market had it is there is a fear of entrenchment. So the longer you see these core goods patterns remaining high, the longer that you see services inflation continuing to accelerate. And, we can write books about shelter inflation, and we won't do that here. But the longer it stays at those very elevated levels, and, we saw rental inflation, for example, at levels we hadn't seen since the 80s. There is an entrenchment fear. And I think that is what both the Federal Reserve certainly does not want to see. And both the bond and the equity markets were reacting to after the CPI print.
Yeah, so you think about it, you point out a great point. So the S&P dropped, I believe, 4.3% the day we had the CPI number. But we had a 5% bounce the 4 days going into it. So something like you just kind of unwound what was there. Now, trust me, as investors, these roller coaster rides aren't fun. I mean, I grew up trading options for 11 years. I'm not your average strategist. I like to look at sentiment and technicals, momentum. Do you think there's anything to the fact that September historically is simply volatile? It's like the most volatile month out of all of them. And here we are in September, and we're getting volatility.
Yeah.
Same old story. Yeah.
Is it that simple, or is there something there?
I would say that it's as simple as that. If September was the only month we were getting volatility this year.
Good point.
But alas, that hasn't been the case. So thinking back to what we saw from the June FOMC meeting all the way coming into the Jackson Hole meeting on August 26th, we saw that big rise in the equity markets, which nobody was expecting. It was the most unloved rally. But prior to that, you had a massive sell-off from March to June. And these are double-digit moves that we're talking about, depending on which index you're looking at, right? So I don't want to say 10% on this versus 15% on that, but everything was down and then everything rallied. And then going into Jackson Hole, not even before the Jackson Hole meeting itself, we saw that big rally, and then we saw the unwind. So I wish it could be as simple as a September vol event, but I think it's a broader story than that. And unfortunately for our listeners, I think it's here to stay. This higher level of volatility is going to be with us for some time past September because we're in a new regime.
So that's one thing we've been trying to tell our Carson partners and their clients that, hey, September into the end of October can be more volatile, so just be aware of that. But Sonu, the day after the CPI, we had PPI, the producer level.
Right.
It seemed like it came in all right. Remember we've had the PCE number was pretty decent. I mean, so you had some inflation's okay. Explain that to me. And then one more, I saw the cost of health services were in the PPI was actually down. It was up a lot with CPI. Can you square that circle for me?
And that's a good reminder that there are different measures and gauges of inflation. I mean, the Fed actually prefers the personal consumption expenditures index, the PCE index, and what a lot of prices that go into that index actually come from the PPI index, the producer price index, because the personal consumption expenditures index measures what businesses are selling to consumers. The CPI measures what consumers are buying. They should sort of match, but they don't. You know, just the way these things go. But PPI, to your point, right, the producer price index, when it came out for August, the August numbers said that medical care services inflation wasn't as high as we saw in CPI. So when the PCE index, I know, like throwing so many terms out there, when that comes out a couple of weeks from now, we should probably see things maybe not as strong as we saw in the CPI services piece of it. And the other side is within PCE, shelter, Gargi is talking about shelter. That's the weight is only about half that of that in the CPI services index, right? So therein, there are methodology differences, things like that. But even going to the producer price index, I think we're seeing margins compress. Like we just talking about used car dealers. I think margins are compressing there, but we are not seeing it in the CPI. And maybe it's just patience and that we have to, it's a timing thing.
Yes.
Maybe you just wait. And the question is, I think maybe investors are worried that the Fed will not have patience, and maybe a good reason. They've been burnt before, right? Last year they said this whole thing will be transitory. That hasn't played out, and they're like, okay, we need to really tighten things. And to Gargi, I'm curious, does this change anything for the Fed?
So they've obviously already been very, very mindful about the inflation risks. And, what I heard from Chair Powell, and I'd love to see if that squares with what you both thought, but Chair Powell made it extremely evident at the Jackson Hole speech that this is a Fed that wants higher for longer. They pushed back massively against any cuts that were priced in for the entirety of 2023. And there was that, Draghi do what it takes, but obviously not
on the
to
opposite
support
side,
the economy, but to fight inflation. And it wasn't just Chair Powell. It was every speaker. So if you listen to Bostic, if you listen to, even Kashkari,
we were
who
talking about
obviously is a dove.
Not a dove anymore. We talked about it on the podcast last week.
Historically has been a dove. So this is a very unified message coming from the central bank and coming from all the presidents and the governors at the FOMC that are saying to us that, look, inflation is real. We are going to fight it. Now, the question is, for investors' mind, for my mind, as I think about this from an asset allocation standpoint, are they going to fight it to 2%? Or will they tolerate a level that is somewhat lower than today's level, but higher than the 2% level? Because therein lies the difference between a deep recession and an unemployment rate that moves up meaningfully higher. And we are all concerned about, a much more protracted recession. Versus something that may even look like a soft landing or a shallower recession. So how much are they willing to trade off their target for 2% versus thinking about the unemployment rate picture and obviously growth?
Now, they can't come out and say that, right? They can't come out and say, we may be okay with 3%. They may be okay in, 6 months from now, like you said. But like Ryan, you always say it's better to jar than war, right?
Right.
So
I use a quote. Churchill said it's better to jar than war. And I think there's been a lot of jar from the Fed. Like you said, it's a coordinated attack almost, if you will. And I made the joke after Jackson Hole. Volcker was 6'7", the tallest Fed chairperson ever, and Chairman Powell's like 6'2". I said Chairman Powell probably should put some stilts on and be 6'7", because he's turning into Volcker, is what it would have felt like when I heard him speak. But where do you think? So right now, Gargi, we've got 250 on the upper range of the Fed funds. Where do you think they're going to stop? The million-dollar question. So easy.
Yes.
Yeah, I think about 4%.
Okay.
I would imagine that they get to 4. I think we're going to see that in their S&P forecast, that they guide us towards that 4%. I think this is a Fed that actually thinks they're being transparent. We may not think so, but I really think they want to be as transparent as possible.
Sure.
I think they guide us to a 4% Fed funds rate. I think that's where they go and stop, to see the delayed impact of monetary policy on the real economy. I don't think that's where they'll stop forever. Maybe in 3 months, if they need to hike again, they could, if inflation hasn't meaningfully returned towards their target, not at their target, but towards their target. But I think they have to watch to see the delayed impact. We all know monetary policy works with a lag. Let's allow for policy to work for a few months. So I think 4% is significantly above that, their own estimates of neutral. And it is a good place for them to pause and see how the economy reacts.
Yeah, I mean, we are doing this before the Fed meeting, and, we've had 2 75 basis point hikes. In all likelihood, we'll probably see a 75. Do you think it'll be, there's a, to quote Jim Carrey, Dumb and Dumber, you're telling me there's a chance. Fed fund futures, what is it, almost a 40% at the time we're recording this?
30-40%
Yeah,
chance of 100 basis points?
100 basis? We don't either, but famous last words, I guess.
Yeah, I mean, never say never.
Exactly.
Okay, so here's what I'll say. If they are going to do 100 basis points, I think we'll get a Wall Street Journal article from Nick Timiraos on that.
Right,
Sure.
the
I
Fed
do
whisperer.
not think this will happen without any kind of warning. I don't think
they will
just come on
telegraph it in
Wednesday.
some
They'll telegraph it from what we've seen in the past,
Yeah.
from a newspaper
Right, good
article.
point.
But I don't think that's likely to
And
be
I've
the
always got a
case.
kick out of it because we're in the, what do you call it? The Fed window?
Blackout.
The blackout. Thank you.
Right.
And then you have, Yellen comes out and starts talking, because she's allowed to talk because she's not in charge of the Fed anymore, but, she's in charge of Treasury. So they still get their words out. So Sonu, this is a very new podcast. I probably should have pointed this out. So I am the chief market strategist here at Carson. Get to do a lot of fun stuff.
Yes.
What exactly do you do for the team, and how do you help our partners?
Goodness, my title officially is
It's a mouthful, I know.
Director Investment Platform, but never mind that, right?
Yeah,
but
right.
it's a lot of asset allocation stuff. We manage several strategies. I mean, together, right?
Yep.
Along with Bert as well. We have our asset allocation committee. I focus a lot on the macroeconomy and how that interacts with markets, both, cross asset, where we're talking about stocks, bonds, but now commodities, real estate, all of that, right? It's helping our partners really and advisors allocate and figure out how much commodities do we need, or do we need commodities in the first place? And are they acting as an inflation hedge, or, what do we do for the long term? Do we keep commodities, or do stocks work as an inflation protection over the long term, right? And real estate, things like that.
Yeah, so again, we're coming to you from the Excel Conference, Carson's Excel Conference in Las Vegas, having a lot of fun at the Cosmopolitan Hotel.
Sure.
And yesterday, Bert White, our chief investment officer at Carson, gave, it was one of
That was
68
spectacular.
minutes. It probably was the best financial speech I've ever seen, presentation. You ever seen one better?
I mean, if I ask you, Ryan, or even Gargi, someone's going to present for 68 minutes with 208 slides, what would you think? I'm like, you're probably not going to go in.
I'm going to say that sounds terrible.
I'm a market nerd. I'd love it.
Right.
It would be right up my alley.
Yeah, the neat thing is Bert will be on stage here as soon as we're done. Guys, we've got about 5 minutes. I mean, it's amazing how fast time can go. Gargi, I mean, he got me thinking, how would you construct a portfolio? What do you think of commodities here? Growth, value, small, large? And again, take note of the time, not a lot of time, but how do you see the world
Yeah,
here?
sure. So on the equity side, we are still quite cautious. Price action, even after the moves we've seen year to date, because I don't think we've seen the earnings forecasts getting revised lower in the way that we expect them to happen. So stay invested, but stay in the minimum volatility sectors of the market where you're going to have a little bit more of a resilient outcome.
So more defensive.
So more defensive. But then investors usually go to these defensive sectors without thinking about what is priced in. Within the defensive sectors, actually, we think utilities perhaps are already fully priced in. But what isn't, or what looks more attractive, is healthcare.
Yeah.
So telling investors to move to pharmaceuticals and healthcare providers. And actually, this is very exciting for me because I've spent 20 years in the fixed income markets before moving to our iShares business. Fixed income is looking really attractive once again, especially in the front end of the curve. So as of right now, the idea that you can basically go out a year or 2 years out of cash and earn close to 3.7%, 3.8%, I think that's really attractive. I call it my yield of dreams. And then looking at very high quality credit, IG credit, again, in the front end of the curve, and shorter dated inflation linked bonds. That's another one that I think makes a lot of value.
How should investors think about duration, right? Because most of us are benchmarked to the US aggregate bond index, which has high duration. I think everyone's like, to your point, like if you can get 375 just by using 1-year treasuries, why not? I mean, do you want to take that extra risk? Should we take that extra risk?
So as of right now, we came into this year, in fact, from middle of last year, in our investment outlook, we called for investors to be underweight duration. So we are actually telling investors to cover that underweight in the belly and the longer end of the curve. So get flat, get closer to fat, or start thinking about covering it. We've had this massive backup, but I wouldn't go long here. I would not be going long here yet, because I still do think we can see a little bit of risk premium come back into the curve. Obviously, September is the month of quantitative tightening. Let's see that play out in the markets. I still think we could probably see maybe 350, 375 on the 10-year note, not calling for a 4-5% like
assuming
many
it's
others.
not already there right now as we speak,
well,
right?
yes,
Who knows,
assuming it's
right?
not there by the time you're hearing this. But the front end is where I'd stay for now, and then cover the shorts in the belly and the longer end, and wait for maybe 20 to 30 basis points higher than here. Call it 350 to 375 to get there.
So how, so the average listener, how could someone use your products, and how could they use your BlackRock and help themselves invest some?
Yeah, please. So first of all, we would tell everyone to go to iShares.com/insights. That's a great place to hear from all the thought leaders across iShares that are talking about, the macroeconomy, like what we did right now. My team and many other teams are writing their thoughts there. But really think about, using iShares ETFs to be very diversified, and especially in these high volatile markets, being nimble. I think being nimble and that ability to have the, to move in and out of your portfolios very quickly, I think makes a lot of sense. So using iShares ETFs as either a liquidity sleeve or an asset allocation tool for your portfolio.
Well, obviously, at Carson, you guys are great. We're great partners together, and we really appreciate, the sponsorship out here in Vegas. And honestly, you sitting down with Sonu and I talking a little bit. So we have a couple more minutes. Sonu, what are you looking forward to doing in Vegas? No more market stuff. What do you want to do the next 2 days? Something fun you want to do?
There's some great restaurants here that I'd like to try out. And, we are at the Cosmopolitan. I watch a lot of cooking shows, so I'm a big fan of chefs like David Chang. He's got a restaurant, Momofuku, down here.
What'd you say? I'm teasing.
Bobby Flay, who's I'm a big fan of as well. So he's got a couple of restaurants.
Actually,
I don't know if you'll get time to hit all that, but
so you're based in New York, right?
I am.
So is it Carboni or Corbone?
It's Carbone.
Carbone. Okay, so sorry, I don't know anything, but I went there last night in Vegas.
How was it?
Oh my goodness gracious! Shout out Jimmy. Thanks, Jimmy, for taking me. It was awesome. He's like, I know some Italian steakhouse. I go, okay, those are two things I like. So no, that was awesome. So we call this facts versus feelings, right? And maybe I'll give you the final word, Gargi. I mean, what's something just your average investor needs to know? Because we hear things, but does it matter? What's one takeaway in your over 2 decades in this industry that someone should remember when it comes to investing?
So this is something that I think about a lot. Especially now because the market's so volatile, we can't control the volatility. We can't control the price action. We can't control NASDAQ having its 5th worst day in the last decade last week. What we can control, though, is our reaction to it. What we do. When are we panicking and moving to cash? When are we just tilting our portfolio ever so slightly to minimum volatility? So think about the volatility as a given. Think about your reaction to volatility in the markets. And by the way, this can apply to races, your marriage, your friendships, your food choices.
It's all our feelings.
But yeah, I would say think about it particularly now because of the volatility in the markets. Control your reaction. Stay invested.
I love it. Sonu, anything to add to that? I thought it was pretty awesome.
No, I think, being aware of our feelings, really, right? And what we see on our screens, or, what we see on our statements, all of that, be aware of what it can do to you, and stay on track. And yeah, stay invested, right?
Awesome. Guys, I think we're at the end. Sonu, awesome as always. Gargi, thank you for being here.
Thank you, Gargi.
And thank you to all the listeners out there to this brand new podcast. We're going to keep doing it if you keep listening to it. And maybe the following one, Sonu and I will give you an update if we got lucky at the tables or not. I always lose out here, though, so that's all right. But we'll see you right next time. Take care.
Restaurant reviews.
Yeah, food's a lot better review. That's right. See you then, guys. Thank you. Bye-bye.
Thank you.
Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.